Good morning, good afternoon, everybody. Good evening in Europe if you're with us from Europe. Joe, Matt, thank you guys for helping me set this up. This is the Bitcoin Layer's very first FOMC live coverage event. We're very excited to get this going, and we at the Bitcoin Layer want to be that research provider for you guys. Uh, Somebody who, first of all, can provide a free service like this live coverage of the FOMC, give you inside baseball on the rates side of things. That's my background. I come from the interest rate side of the asset management industry, as well as cover Bitcoin. So, the most important thing that we are going to talk about today is the FOMC meeting. But the most important price I'm watching is still the Bitcoin price. So that's what we're here to do. We're going to cover the Fed. We're going to cover how it is affecting Bitcoin and the Bitcoin price as we see it right now on our screens. Joe and I are both going to have the charts up. We will cover what the Fed does at 11 o'clock, and we will cover the price action. Hopefully, we'll have some guests join us as well. And then later on in the session, we will definitely be opening up to Q&A. We want to hear from you guys and what your thoughts are. So again, thank you to Matthew Ball for helping us put this together as our creative director of the Bitcoin Layer, and Joe Consorti, my tremendous research associate here with us at the Bitcoin Layer. I'll pass it to you, Joe. What are your thoughts here as we are 19 minutes away from the Fed?
Yeah, for sure. Well, I think ultimately, if markets get what they want, if markets get 75, I think that's not an event that's going to upset them. So I don't think you see any major negative downside. Watching Bitcoin is good up here now because obviously that's very, very high beta risk asset, and so it'll tell us how the rest of risk is really feeling with really high sensitivity here. So yeah, I don't expect any negative downside moves if we get 75. I've been listening to Bloomberg for the majority of the morning, and they've sort of been echoing that as well. There's actually a lot of buying, a lot of bidding up on futures going into the rate decision that's happening in just 18 minutes now. And so, yeah, I think, if markets get what they expect, then there isn't going to be tremendous downside, right? If markets
And
get
and
100, if they get surprised
and
to the
just
upside, that
clarify,
could be different.
yeah, just clarify for us, Joe. You're talking about risk assets, right? When you're talking about downside, so we're talking about stocks and Bitcoin here.
Correct, exactly right. Yeah. So obviously, assets with high interest rate sensitivity, if we get a move to the upside that is what higher than anticipated, that would obviously be deleterious for risk assets. You'd see those sell off.
Right. So, okay. So we have a couple minutes here before the official start of this, as far as the announced time, 10:45 a.m. Pacific time. So I'm going to give people a couple minutes to get in here before we start striking our levels. And striking our levels, by the way, is a term we use on the trading desk. It just means, hey, what are the prices before the event? And then we'll look at them again after the event. And so we're starting to get to that point where we're marking down where the market stands. I have a bunch of charts open on my screen right now, but until that 10:45 mark, I do want to just remind everyone the Bitcoin price is what we're watching here. It is why we have launched the Bitcoin Layer, and we do want to be this hybrid Bitcoin global macro research and education provider to you guys. And but the focus, I think it. I want to remind everyone that the focus still here is on Bitcoin. We're covering the Fed because the Fed affects the business cycle. The Fed affects the market cycle, and the market cycle affects Bitcoin. We've covered correlation now a bunch. Our most recent YouTube video, by the way, everyone, go subscribe to our Substack. We got free weekly market updates that go out to you guys. Go subscribe to the YouTube channel at the Bitcoin Layer. The YouTube channel, twice a week, we're doing research, education, and analysis on Bitcoin and global macro. The most recent video was covering the Bitcoin S&P 500 correlation. And a lot of us like to think about Bitcoin as being this risk off asset that will protect us against long term exposure to government currencies and really poor fiscal situations, really easy monetary policy. However, when looking at the actual data, we can see a very strong correlation of Bitcoin in the stock market over the last several years. There are nuances there, one of them being that when Bitcoin is going through one of its mini parabolic moves, it's usually decoupling from the stock market. And and in those times we see correlation fall. But pretty much since the first day of governments shutting down economies of in February, March of last year, we saw the correlation of Bitcoin and stocks rise to essentially not one, but in a way that the correlation is completely undeniable, right? You can see it at the tick level, at the daily level, at the weekly level. And so that dynamic is something we have to acknowledge going into an event like this, because it means that when we're watching the moves in rates, and we watch the moves in risk and how risk responds to rates, we're talking about stocks and Bitcoin. So that's why Joe and I are using this catch all term of risk. We're referring to Bitcoin, of course, because that's our focus, but it's Bitcoin, it's the S&P, it's the NASDAQ, it's high yield credit spreads, it is commodities. There are lots of things that can be called risk assets. The correlations vary from time to time, but the one that we know is locked and loaded is this S&P 500 Bitcoin correlation, and it does underpin a lot of what we're looking at.
No, Nick, it's going to be especially interesting watching that correlation moving into Q4 of this year and then through next year, because obviously the messaging from the Fed has been higher for longer. Now, the last time we saw the Fed hike rates, we obviously had the notorious Powell pivot, but according to him, that doesn't seem to be coming anytime soon. Obviously, we've been discussing a pause, but rates have really blown through several key levels, and so when that pause happens is still up in the air. But based on what the Fed is saying, if we're taking them at face value, this will be really the first time that you've had a sustained period of monetary tightening while Bitcoin is like a major asset. You obviously had it in 2018, but as I said, that was immediately followed by the Powell pivot. You saw risk sort of start to rebound there. But really, the guidance from the Fed is that they're not necessarily coming to save risk markets, at least immediately. Their priority is inflation. And so watching this Bitcoin S&P 500 correlation in a time of sustained monetary tightening where Bitcoin gets traded like a risk asset, but it's not a company, right? It doesn't have a cost of capital. So like, the interest rates that are rising here, it's just major market players reacting to that and then selling Bitcoin. It's not as if the fundamentals of Bitcoin, the asset, are changing at all. It's really just how it's traded. And so in this period of higher for longer on Fed funds, which obviously, other rates remain elevated as well. It'll be interesting to watch that correlation and see if it wanes, see if it gets stronger, see if both of them sell off in tandem, or Bitcoin sells off with even more magnitude, or if this is sort of the beginning of some kind of paradigm shift where you see Bitcoin, because of its very low liquidity, catch a bit at these levels and remain here while there's this sustained period of what you'd expect to see a period where you'd expect to see risk assets stay range bound because of very, very elevated rates.
Yes, and I want to reset us right now. Welcome everyone to the Bitcoin Layer's first ever live coverage of the FOMC decision. That is approximately 10 and a half minutes away. We are looking forward to covering this event for you, covering it from a Bitcoin angle, covering it from a rates angle, bringing both of those perspectives to you. I watched FOMC decisions from a trading desk at an asset manager with over $100 billion, over $20 billion on my book. Personally, I was responsible for the U.S. Treasury cash portfolio, and that would make up, at least 20% of our assets under management at any given time. And so that was my responsibility, and it was also my responsibility to watch these FOMC decisions down to the second and give the portfolio managers and the higher ups all the information they needed to make certain portfolio decisions. Now, I wasn't managing the portfolios themselves. I was trading the treasury book. And that's an important distinction, just to give you all a sense of who I was in the industry. I was not the person that was saying, okay, it's time to get long or short duration, long or short risk versus the benchmark for $100 billion. No, I was in charge though of trading on both an execution level and on a relative value level, the 20 billion plus in U.S. Treasury securities that we had. So this is definitely my cup of tea here. This is kind of my Super Bowl when we get the FOMC decision. Um, I know there are a lot of feelings sometimes about the Fed and how much effect they have on our markets, and I do empathize with that. But I also do have to cover this, and so I'm really excited to get this going here. 9 minutes to the Fed, and I'm going to reset the markets for everyone right here, going into the decision and what I'm looking for. So let's first talk about what the Fed is going to do today. The Fed is expected to hike rates 75 basis points. That would be the third consecutive hike of 75 basis points. That would take the upper bound to 3.25 from 2.5, and the lower bound to 3%. That would send Fed funds somewhere in the middle, so call it 312. And that's just a function of how the Fed manages their Fed funds target. It's a window of 25 basis points. So we expect the rate to move uh, from 2.25, 2.5 to 3.25. I'm Yes, 3.25. That's the range that we're going to. We did have a brief scare in the market last week, or actually at the end of the week before last, where we thought maybe we would get 100 basis point move out of the Fed today. The market faded that and brought the expected rate down to about 79 basis points, where it stands going into the meeting. And so we know that based on that 79, Powell is not going to do anything extreme. He's going to hike 75, and we can be fairly sure about that. The Fed does not like to upset the market in the micro. The Fed did, however, get the Wall Street Journal to move the market from 50 to 75 basis points in June with 48 hours until the meeting. And that was a little bit unprecedented, I might just say, in my career, seeing the way that the Fed didn't get the market exactly where it needed to be and then needed to leak through a financial publication what it was going to do in 2 days because the expected rate hadn't reached there. So I found that very interesting. And I found it interesting that they dangled it, 8, 10 days ago, and then the market faded it. So the Wall Street Journal went silent and didn't address it anymore. And then yesterday came out with an article basically confirming 75. So that's been interesting to watch for sure. Let's reset the market. So Bitcoin, the local low, and I mean local in terms of the last week or so, um, got down to just above 18,000. It had a nice little candle here in the last hour where it's trading about 19,500. And I want to remind everyone how close we are to this support level on Bitcoin. We call it behavioral support because we think of these technical analysis levels really as ways to analysis behavioral impulses from the market. So when the market keeps buying Bitcoin at around 18,500 time and time again, we know that there's this psychological floor there. And if that level doesn't hold and it wicks down into the 17 handle and flirts with the level that we had in June, there is no denying that Bitcoin could go down several $1,000s in a few minutes here while we are on this basis. And that's a real possibility. Market moves two ways. And I thought that it would be interesting to cover this particular FOMC meeting because of how dicey the Bitcoin price really is right now. Now, you guys know if you've been reading and following along, my base case scenario is that Bitcoin had its bottoming really this summer after this big leverage wipeout. Um, but I don't have a crystal ball, and I'm also the price is truth guy. That is what I believe in, and the price will tell us what is happening. So if the price negates my bottoming thesis, we have to look at it, address it, and understand why that's the case and what might happen over the coming months if it does. A big red candle is we call it damage. We actually call it damage because it damages the behavior of the market and makes it unable to reclaim that level until a long time has passed and certain levels are digested through the market. So that is why we watch all these levels, and we'll be watching that very closely. Going over to the rate side of things, we're looking at the 2-year yield had a local high this morning of 4.02. So this is the first time twos are above 4% since 2007. 15-year highs in 2-year yields this morning. Um, Another rate we're watching is the 10-year yield. The 10-year hit a local high at some point yesterday of 3.6%. We're trading about 3 to 4 basis points lower than that right now. And this is a very, very flat yield curve. So I'm counting about 42 basis points of inversion right now. And as the Fed keeps on its hawkish rhetoric, we can expect 2-year yields to continue to rise or stay elevated. Meanwhile, future growth expectations are they come down when the Fed gets tighter, and that's why we see an inversion. So we'll watch for this curve and see if there's any deeper inversion coming or any flattening. And the last rate I'll strike is we're 3 minutes here before the Fed decision. The last rate I want to strike is the terminal rate. This is the Fed funds rate that is the highest at this point in the cycle. Right now, it's somewhere between March and May, and it's trading above 4.5%. So remember, today the rate goes to about 3.12, and the market thinks it can get all the way to 4.5%. So that is a huge move. And that's the setup that you guys need to understand here going into this event in 2 minutes. It's not what's going to happen today. We know they're going to hike 75. There's no drama there. The drama is what happens after it gets to 312. Will it get to 4.5 or not even close? We are at the Bitcoin layer biased towards that it won't make it much above 4%, but the market has the rate going to 3.8, basically another 75 in November. So will that 75 for November hold? Based on what the Fed says in 2 minutes. And remember, we have the press conference also coming up a little bit after, and we'll be watching those headlines as well. So 19,475 on Bitcoin going in, 398 on twos, 357 on tens, and about 3,900 in SPOOs. That's the S&P 500 futures there. So Joe, what are your thoughts here with about 90 seconds to go?
For sure, 90 seconds to go. The fact that the Fed is reignite, and by the way, everybody, we'll start allowing people up on stage a little bit after the rates decision, so we can all sort of discuss, and you can pose questions to the both of us. But it sort of speaks to the fragility of the system that the Fed needs to reignite this Wall Street Journal forward guidance mechanism. That's how fragile the system is. They want the market to know explicitly what their moves are going to be. They don't want any ambiguity, and that's why you saw them revise down via the Wall Street Journal from 100 to 75 once that's where the market was leaning. And that's why we're watching twos so heavily, because those represent forward Fed funds expectations. Right now, reaching the four handle, they're sort of taking the Fed's word for it that we are going to see a higher terminal rate. And I do have the terminal up in front of me, so I will have the rate decision when that ultimately comes out. But yeah, no, essentially, as you see that gap narrow between the 2-year yield and Fed funds, you know that the window for the Fed to hike is closing, as well as these Fed funds futures contracts. Basically, market sort of betting on the probabilities. Right now, it's 4.5 for terminal. Frankly, again, we're biased to believe that we will not get there. Highest level for these yields, since 2007, really seems like a very, very unlikely scenario that with the extreme fragility you see in markets right now, we can hike much higher for longer.
Yeah, and it's not just markets, it's also the economy. The economy is in recession right
All
now.
right,
Okay,
so it
we have
confirmed for 3.25. So it is a 75 basis point hike. It looks like twos are getting bid up slightly.
okay, yeah, I see Bitcoin popping, I see yields up. I see yields going up here. So we have the 2 year yield now at 4.06, so about 6 basis points higher than where we struck it. And tens moved to 3.64, but are coming back down. These markets are choppy, guys. Now risk is falling. We see Bitcoin get to 19,900, so up 400 in the immediate few seconds, and it's down over $1,000 from that level back down below 19,000. So huge swings, and we'll wait for a few more headlines to come out here, and I'll give you my take as we go. So, Joe, why don't you read maybe any of the red headlines that you're seeing while I gather my thoughts.
For sure, absolutely. Let me pull up the news here. I'm also letting so okay, so basic so red headline number one, Fed hike 75 basis points. Median forecast shows rates 4.4% at the end of 2022. So more hikes, not just into Q1 of next year, but this year. We're going to start reaching close to terminal at the end of this year. So continued aggression, which means chances are another major hike in November, another major hike at the December meeting as well after we have this October break. Fed repeats it anticipates ongoing rate hikes are appropriate. So really, they're being clear here. There's no ambiguity whatsoever. Again, yeah. So the updated dot plots show 4.4% at the end of 2022, 4.6% in 2023, and 3.9 in 2024. So really, terminal is still flashing 4.5. And really, there won't be anything close to a pivot per se or rate cuts until 2024, which is really what Powell has been flashing forward. Again, higher for longer is the narrative here. But the question that comes to my mind again is how much more of this can the economy really take? Like we take a look at these risk assets, and ultimately, it's unfavorable for asset prices to have these really precipitously rising costs of capital. But what is it like for the real economy? And that's why we're watching things like continuing claims. That's why we're watching things like owner's equivalent rent, these leading indicators that point towards, okay, what's the economic deceleration look like? How is it affecting the labor market? How is it impacting forward-looking CPI indicators? And as of right now, really, the Fed's playing a very dicey game here. Debt levels are extreme relative to where they were in 2007. And we talk about the 2 year yield being higher than it was in 2000, the highest level since 2007. And right now, it's reaching that 4.1 level. Actually, it's selling off back up to that level. With rates this high, with forward Fed funds expectations this high, how much more can the real economy take when we're very over indebted, right? We've had 14 years of rates locked basically at or near zero. There's been this sort of chronic misallocation of capital because money is essentially free, right? You've got this extreme moral hazard. People are incentivized to borrow when they can't necessarily service it. And you've seen that all across the board, whether you're a company, an individual, or even a nation state. So it's going to be interesting. Certainly, I think that the fragility of the world, the Fed's walking an extremely tight rope here. The runway, we call it a Fed runway. It's more like trying to land a 747 on a piece of floss. Granted, there is a route for them to achieve a soft landing. I think that would involve them pausing sooner rather than later, but it doesn't seem like that's their intent. I think pausing sooner rather than later, allowing the markets to digest this, allowing disinflation to set in, is the way that you get the quote unquote soft landing while getting unemployment up to maybe the 4.5 handle. I think if they decide to go aggressive and then pause for long, I think that's when you get into a situation where a hard landing looks much more likely. But those are basically I read off the headlines. I gave my thoughts. Nick, if you're ready, I can give it back to you.
Yeah, absolutely. Watching stocks here move a little bit lower, and watching really this quite large Bitcoin candle here. If let's say you're looking at a hourly candle here, quite the chop. It's striking this here from 18.7 to 19.9. We're talking about a $1,200 candle here on the 1 hour. So but Bitcoin again, like holding this 19,000 level. So looking at twos are really moving. Twos are now at 4.12. So it's a 14 basis point move on twos higher. The 10-year yield is a little bit higher, but really only 3 basis points. So again, more of that flattening, deeper inversion. We just said we were at about 42 basis points inversion. Now we're at 51 basis points of inversion, just like that. And so this is the market telling the Fed, you are going into a policy error. You are over tightening. The growth expectations on the long term are coming down relative to your policy rate, which is basically too tight. And this inversion is something that the Fed will not be able to ignore forever, as well. So it's, yes, we have to take the Fed's word for it that they're going to do this once again in November, and that's why twos are selling off here. Because when the federal funds rate goes from 312 tomorrow to 380 in early November, you're only one hike away from getting rates to 4.25. So with twos trading below 4%, that's almost a no-brainer. It just goes there on math. The 2-year yield is a direct reflection of where the market thinks the policy rate is going over the next 6 to 18 months. And the 2-year yield kind of prices all of that in. So with Fed funds really already now getting locked in by the market to the upper bound to get to 4%, it makes no sense that twos are below 4%. I said the same thing also when twos went above 250, 350. The the thing in the market that makes me the most convicted about where we stand in the risk cycle of things is this diversion between yields and risk. Why is it that, and I'm going to have to zoom out on my chart here, why is it that twos reached 345 in June and it caused this enormous sell-off in stocks and Bitcoin? And here we are now, 70 basis points higher than that, and Bitcoin and stocks still aren't back at those levels from June. That is the most interesting dynamic. It's a divergence. Why is it that the sell-off was caused by the increase in yields, but then the next wave of the sell-off hasn't caused in yields, hasn't caused the next major downside in risk? And why is the VIX, the volatility index, only at 27? Where is the fear in the market? Why aren't high yield spreads at the widest of the year? Why are they lower than where they were in June? I keep saying the word why here, and it's because I believe the risk markets think that the tightening can't go on forever. They'll have to pause and there will be some relief. Or just those investors are not willing to relinquish their positions because of how fast the Fed caves or will snap back from tightening back to easing. So it's not our base case that they go easing, but it is our base case that they go that they pause and hang it there for a while. So yeah, those are my thoughts here. Bitcoin definitely hanging in there, holding 19,000. Stocks are only down 1/3% today. That's nothing, and they are actually, um, you know, let's call it 25 handles above the lowest of the week. So very interesting in terms of risk assets hanging in despite a crazy, crazy move in yields. And if you guys have been following the Bitcoin layer, you know that many months ago, I said, I don't think tens are going above 2 3/4. Well, then I had to say, okay, they're getting too hawkish. It's going a lot higher. Then yields hit 350, and they came down 25 basis points, 40 basis points really quickly. And I said, hey, look, we're going back to 250. We got to 250, and it's moved all the way back to 360, beyond the level where I thought we would hit the highs for the year. So a lot of pressure on risk assets from yields, but they're hanging in. So, Joe, I want to pass it to you, and then TXMC, one of our founding members at the Bitcoin Layer and a tremendous macro analyst, is in the room. We'd love to have him on stage. I've sent him an invitation, but I know he's probably looking at markets and looking at other things as well. So, Joe, why don't you tell us where you see the Fed funds market? Has there been any change? I know the OIS market is sometimes slower to update in Bloomberg, but what are you seeing there from your side, and what are you looking for?
For sure. Yeah. So the Fed funds market, it repriced swiftly upwards. November was looking pretty ambivalent between 50 and 75. It was sort of teetering that 60, 68 level, sort of that in between. But now it's firmly in 75 territory and actually climbing beyond 75 for November. So, the odds of another sort of jumbo sized rate hike are increasing here. Moving into November, which is certainly interesting. I guess with these sort of jumbo rate hikes, the Fed tends to believe that inflation core, may be stickier than most anticipate. Obviously, we had that minor uptick. We'll have to wait and see if that remains sustained. Obviously, core is generally stickier than headline. But if that continues ticking upward, or if it remains sticky, then of course you could see another jumbo rate hike. And as of right now, with the Fed's continued hawkishness, markets are expecting through Fed funds futures that we're going to see another 75 basis point hike in November. Obviously, the clarity of this, the accuracy of this, it isn't necessarily all there when we're still 2 months away. But usually one meeting out, it's a surefire bet. And as it approaches, we'll of course be updating everybody on that via both of our Twitter accounts and the Bitcoin Layer. The link to subscribe to the Substack up in the nest is there. It's totally free. But some of the headlines here. The Nasdaq is it's looking okay. Bitcoin obviously it bid up slightly it bid up a little bit into the event, and now it's back down towards the top of that $18,000 level, like 18.9 right now. And this it just sort of goes to show, there is still strong support here. Risk isn't necessarily blowing out or blowing up by any means. VIX is still at 26. High yield credit
Can you
spreads, which you
take
did.
can you take a look at the VIX? Just seeing, um, I'm seeing also that VIX 27, but I see that it might have gotten to 30 on a pop and then come right back down.
Yeah, let me
So
pull up the candles here. I had the
yeah,
line
like
chart up.
5 minutes of fear in the market and then dissipating a little bit. And while you're doing that, TX, why don't you give us your takes? And Jeff, I see that you have also been invited, but let's see if you can come up after TX. So TX, what are you seeing here, dude? What's going on, man? Thanks for coming on.
Yeah, sure. What's up, Nick? What's up, Joe? We got the 75 that the market wanted, and I think there's a swift reaction, but really we're kind of holding the lows from yesterday. We took them out briefly. We're kind of dragging along them now. I think a lot of the move for this kind of thing, when the market gets what it wants, is in the anticipation, right? Like I wasn't expecting that the bottom would just fall out today, depending on the tone of the announcement, which seemed to be almost like word for word from last time, and depending on the tenor of this press conference, which I find more interesting. The thing that's really got a couple things that have had my attention here. The CPI, obviously, we know it surprised to the upside, though very mildly. And if you break it down and you look inside of it, the only thing that saved it was energy being down 5%. There were broad gains across the basket, including in the core section, which I think is where the market really got surprised. And if you look at the pieces inside core, like if you look at shelter, which is flawed and very lagging because of the ways that they measure it. However, it's like 30%. And so when you look at shelter month over month, from June to July to August, it's up 0.6%, 0.5%, 0.7%, like steadily growing month over month. And you see this trend across the basket. I think that's got the market a little rattled. That might have contributed to the overreaction last week. But I wasn't expecting the Fed to change what they did this week because of that, because the surprise wasn't as big as we've had in previous months of this year. But the last piece I'll add is the unemployment piece, right? So they updated the SEP, the Summary of Economic Projections. They had an unemployment rate that they assumed, based on their policies, that next year would only be at 3.9% from 3.7 now. Well, that jumped. That jumped up to 4.4 next year, and inexplicably also 4.4% in 2024. And first of all, it's hard to believe those numbers because they don't really have very much control over unemployment going up or down at any particular pace. And when you look at unemployment historically, I've been tweeting about this a lot, it's an uncontrollable metric. And when it moves up, it does not move quick. It doesn't move slowly. It moves very quickly. It moves slowly when it's going down, when people are getting jobs and there is strong growth in the economy quarter over quarter. But when it takes off, when the wheels start coming off of stability in the labor market, it comes off very swiftly. And it's completely out of the control of the Federal Reserve. And so when I see them talking about how they think their policy is going to generate a 0.7% jump in unemployment from where it is now, well, buddy, if you look for the last 70 years, every single time that unemployment has gone up 0.5% in 6 months or a year, either time it has gone up considerably more than that. And every time with a 100% hit rate, it has been a recession. So I think that their idea of the response to their policy by the labor market is based on fantasy and is not backed up by history. So that gives me some concern about how violent the snap of labor could be if they tighten too far, which history says they're apt to do.
And let me ask you a question, one follow-up, and then let me just give an agenda for the next few minutes here. TX, I want to ask you one question. Then I want to bring Dr. Jeff Ross up for the more bearish view. So I'll give him a little intro as well, so we can keep it balanced here. So when you were saying that, TX, I thought, what if they moved it to 4.4% from 3.9 just because they want to prove they're okay with really moving unemployment higher, even and not stopping the tightening? Do you think that it's maybe just almost communication that they're saying, hey, we're willing to accept much higher unemployment than we maybe told you 3 months ago, and the economy is not something that we're coming to rescue, the stock market is not something that we're coming to rescue, and you guys are just going to have to deal with it? What are your thoughts?
I think I agree with that, Nick. And when they show us their projections like this, the absolute value is less important than where they're suggesting directionality will be and the swiftness of it, right? And so I think you're right. They're showing that they're willing to push the labor market further than people are comfortable with. But for those of us who pay close attention to the things that the Federal Reserve says, they've been giving this information to the market for several months now. You can go all the way back to May to a really candid interview that Jerome Powell gave to marketplace.org, where he basically said the labor market is ripe for us to tighten much further and create joblessness. And then in June, when we had the first 75% or 75 basis point hike, there was a reporter in the press conference that asked Powell directly, do you think that if unemployment goes up higher than your projections, but inflation is being dealt with, that's acceptable to you? And he said, yes, it is. If we are able to combat inflation, but it results in unemployment going up to 4.1% or blowing past our projections, he didn't say blowing, but going past our projections, that we would consider that a, quote, successful outcome. That was his exact word. So they've been saying this. It's just that, I think partially also there's so much information, the market doesn't always pick up on everything they're saying, but they've been very clear that the labor market is going to take the hit for this.
Yes, and that was part of the reason why I wrote about in January how, hey, the Fed, it's not going to cave with a 20% correction in the stock market. It's not going to. They're communicating that they are willing to take some hits here. So we see, by the way, 10-year yields all the way back to 357. That's where we went into the decision. So a little 7 basis point round trip. Twos are still at 4.08, so about 10 basis points higher. So that's 10 basis points of deeper inversion there in the twos, tens yield curve. Bitcoin holding 19,000. Let's reset. This is the Bitcoin Layer's first ever FOMC live coverage event. We're going to be doing this every FOMC event, the next one on November 2nd. We really thank you guys for coming in here. It looks like we have 550 people in the spaces. We really appreciate you joining us today. Go sign up for our Substack publication. We have a free product, a weekly markets update. We have a YouTube channel where we're putting out free educational videos twice a week. So find us at thebitcoinlayer.com. You can find all of our links there at thebitcoinlayer.com.
Let me just add, you guys have a
Yeah.
great publication and you do excellent work. And I recommend everyone go subscribe to their newsletter. It's been very helpful in my learning about the monetary system. And ever since Joe joined the team, the output has basically doubled. You guys are killing it.
Well, we really appreciate that. I'm very thankful to have Joe Consorti on the team and Matthew Ball as well. These guys have really turned Bitcoin into a lot more than it was when it was just me by myself. So really appreciate the team's efforts. And at the Bitcoin Layer, we're not focusing on abstract conjecture looking 5 years out on what's going to happen with the death of the dollar. It's not something that we are all about. I know that it can be popular to talk about the death of the dollar and the absolutely horrific fiscal situation that we're in, the ridiculous monetary policy that we've had. And I acknowledge all of those things and I've written about them. And sometimes I get emotional and that's all I want to talk about. However, the Bitcoin layer is targeting investors that have portfolios that need to make decisions. And so part of that decision should be, hey, you should own some Bitcoin because it's going to be a big part of our future. But you should also be aware of what's going on with the cycle, with interest rates, with the Eurodollar system, and with the value of US Treasuries amid basically $300 trillion of bank debt that's not US Treasury debt, and that dichotomy. So there are a lot of things that we bring to our audience that I think are unique. And I just want to emphasize that is that we're not here to put out a bunch of conjecture looking at the collapse of the U.S. system. I know their fundamentals are bad, but I don't see any collapse happening of the dollar, the U.S. Treasury, the U.S. fiscal situation, or any of that stuff really going on the next few years. And because when I got onto the desk in my career as a younger person, I thought, hey, this is really bad what the Fed is doing. The whole thing's going to blow up, but it just keeps trudging on. And I know that maybe these are my final last words, but it's not the approach that we take. We take just, what's going on right now in the cycle and what is the Fed up to, what's going on. And we hope you guys appreciate that approach. So I want to bring up Dr. Jeff Ross. Jeff, I heard you talk about your views on the stock market. You think another maybe 50% downside in SPOOs due to a variety of things, but including Fed tightening due to very high inflation, which is what the Fed is saying they're going to do right now. So what are your thoughts, Jeff, looking at today's release and maybe giving the other side of, us thinking that risk probably has found a bottom here this summer?
Yeah. Hey, thanks, Nick. Thanks for having me up. Hey, Joe, TX, it's good to see you guys, Sovereign. You guys are doing some awesome work over at the Bitcoin layer. So just kudos to you guys for getting that product up and running. And I think it's a very valuable product. So kudos to you guys. Let's see. So I guess I would agree with what TXMC was saying at first, that I think that there was no surprise at all in this announcement, right? We all kind of knew it was going to be 75 bips. The Fed has been extremely clear on their stance. They've been very hawkish. They say they're going to remain hawkish. until we see sustained decreases or disinflation in those numbers. And I don't think we're going to see that for quite a while. Like, unless we have a deflationary collapse, we're not going to see a significant drop in inflation, I think, for quite a while. Why am I bearish? I mean, I still look at, the 10-2 yield curve. It's now sitting at negative 51 bips right now. So it continues to say that there is extreme trouble ahead for us. We're still headed into recession for sure. I don't even think that's a question. I think it's just absolutely guaranteed. I would suggest we're already in the early stages of a recession. With the 10-year rising to, it's at 4.07% right now. It says that the federal funds rate has a ways to go. I do think that I believe Powell when he says that we're not going to make the mistakes that the Fed made in the 70s, where they paused too early, and the markets appreciated that, and the markets rallied, and then what happened? Inflation came roaring back to even higher levels. And so I think that's the major concern this time around as well, that Powell does not want to pause hiking too early, because if they do, I agree that inflation is going to be sticky and it's going to rip right back, and it could go up to double digits. And then they're in a serious world of hurt at that point. So I just keep telling people, like, I'm normally an optimist. Nick, I don't know you very well. You don't know me very well, but I'm literally normally an optimistic guy. I've never been this bearish ever. I'm so bearish on the markets right now. I think this is going to be at least as bad as the global financial crisis from 2006 to 2009, at least as bad as the dot-com boom and bust. I think we have a long ways to go on this, and this is going to be a painful decade. We're going to see these inflationary bubbles, but then these massive deflationary collapses, and it's going to be very painful for the regular ma investors, for the retail investors. If you're just sitting in a Vanguard 60/40 stock bond portfolio and hoping that what worked for the last 10 years is going to work over this next decade, I think you're going to be really surprised, and you're going to be surprised at the downside. And this is going to be kind of ugly, and you got to have your eyes wide open. You got to pay attention to smart people, I would say, like Nick and Joe and TX, other guys on the stage here. This is going to be a tough decade. So I'll sum it all up to say, I was bearish. I'm just as bearish as I was yesterday after this announcement. I think the Fed is going to be, there is no Fed put. They're going to be hawkish for longer. And in that setting, when you have a clear coming global recession that's starting right now, there is nowhere for risk assets to go, I think, but down. I think at best they go sideways, and more likely they go down.
Thanks for your take, Jeff. What Jeff said about inflation coming back if they pause it's definitely valid from the market side of things, right? So I don't know what's going to happen in the economy, but if the Fed pauses, risk is going to like that. And what happens when risk goes up? You get a wealth effect. And a wealth effect is a boon to the consumer, which can trigger inflation. So there is this, very fundamental chain of events that is possible there. I think where we differ is that I really think that the total stock of debt makes a 4% risk-free rate completely untenable for the system, and will draw the inflation out of the economy, because even though the Kindle Fire might have been 15 years of easy money, the trigger was the pandemic. And so if a 4% risk-free rate can knock out that trigger effect and bring the economy or supply and demand of goods and services around the world more into balance, that we'll see more of the slow inflation or deflationary trend that we saw for the 10 years pre-pandemic. And so that's where I think that we differ a little bit in how really what we're differing in is the path of inflation, and maybe even the cause of it. And that would be the fundamental reason for our difference of opinions in the market. So, and this is what makes the market. And I'm, thanks, Jeff, for coming on, and, please stay on and hop in with more stuff. But maybe we could pass it to Croesus real quick. It's good to see you, dude. We haven't seen each other since Santa Monica, which I think was last year. But tell me, what are your thoughts here?
Yeah, great to be up here. It's cool you guys are doing this for every Fed meeting going forward. I think that'll be a really valuable addition to these days. So my thoughts are, I keep thinking about, like, we get caught up in the details and the weeds of what's going on exactly right now and what the path forward is. But I like to pull back and, like, take stock of how we got here in the first place. And, and that comes back to how much money was added to the system over the previous few years with the pandemic, and triggered by the financial system getting a little shaky in 2019 before the pandemic. But we added 40% to the M2 money supply over 2 years, and that is now showing up in inflation, and is persistent because inflation is this slow process of. I'm of the belief that what inflation is the economy adjusting to find a new equilibrium with a changed denominator of how much money exists. And that takes more time for different parts of the economy. So, if the cost of producing gasoline is pretty quick to react to these changed conditions, but then downstream of that are the prices that businesses set, and then what we saw in the most recent inflation number. The reason that it was a surprise that we were expecting 8.1% inflation, but we got 8.3%. The category that was actually surprising was services. So inflation is showing up in the prices that service businesses are setting now, because they are finally incorporating the higher cost of living, the higher cost of their inputs, and that is flowing downstream from this originating event of adding so much money to the money supply. So this is how we got here, and that forces the hand for the Fed of they need to address inflation, they need to try to bring that down, but they've already printed this money and they can't unprint it. So their choice here is, well, we are going to destroy wealth because of the wealth effect, where when people see the value of their stock portfolio and their real estate go up, they feel richer and they consume more, which bids up the price of everything. And so that's one way to combat inflation in the short term, is to kill demand. You can't unprint the money, you can't change that denominator, but you can kill demand by making everyone feel poor. So that's what the Fed chose as their path, because it was kind of their only path. And so now they're in this position of inflation is showing up a little bit stickier than expected. Services growing year over year more than they expected in the most recent data. So they have no choice but to keep hiking rates right now and going forward, because they have to destroy more wealth than they were previously, than they have so far. So it's the worst year for the 60-40 portfolio in many decades, and it looks like we have to cut a lot more wealth out of the system to kill demand even more, in order to offset that money printing that cannot be undone. So, but this is fundamentally a short-term strategy for them, because in the medium and long term, they can't do what Volcker did in the to finally end the inflation of the 70s. That whole strategy was get inflation rates up above interest rates. Get interest rates up above inflation rates. So they hiked rates up to 15%, and that finally killed inflation. But to do that, we would have to get interest rates up above current 8.3% inflation, which means you would need interest rates up at 10%. And you can't do that now, because we have $30 trillion of national debt. And it doesn't show up right away, but that's where our interest expense, that's where it comes from for that national debt. there's a mix of contracts that are, some of them are short term, some of them are longer term, so it doesn't show up immediately. But eventually, if you were to keep 10% interest rates, we would be adding $3 trillion in annual interest expense on our national debt, at a time when we already are running deficits, and the rest of the world has stopped buying U.S. Treasuries, as or has dramatically cut their purchases of U.S. Treasuries. So, if we were to run an extra $3 trillion of deficits, we would have to print more money. The Fed would have to buy more Treasuries in order to make that even possible, and we would erode the U.S. would erode its financial standing, its position in the world faster than ever. It would be a complete catastrophe. So we're on this path now where the Fed has to keep hiking rates in order to short-term kneecap demand in order to rein in inflation. But there's a short window where they can do that, and beyond that, if it doesn't, if they don't engineer a soft landing or even a not so soft landing, it's going to be really, really ugly really fast.
Yeah, so I want to hop in here. We have the press conference starting now, so we have some headlines coming in from Jerome Powell. We'll keep this spaces open for another 20 plus minutes, covering the headlines out of the press conference for you guys. But you're seeing a little bit of a bounce in risk, and I want to explain why that is the case here. And I think that the point about the wealth effect is a great one. It's now I think we're the fourth person to talk about it today. It is a big deal, and it is this mechanism that the Fed uses here, and they do want to bring that wealth down as part of their toolkit to bring inflation down. But again, I really disagree in terms of where the inflation comes from. We didn't see any inflation in the CPI, and I know it's a poor way to measure, but we didn't see any inflation in the CPI for 10 years of QE. It came after the pandemic. So for me, the trigger of the inflation was the pandemic, and it wasn't the QE. And so that will, in my opinion, that will fade out. And the Fed will cave on the economy because it understands that it'll be forced to understand that a 4% risk-free rate crushes the economy, not just risk assets. Risk assets are doing fine. Risk assets are up 20% from pre-pandemic still. And so the market is bouncing right now because of what I believe is one headline here. Powell says the housing sector has weakened significantly. Now, he's going to be hawkish as much as he can. He says he seeks return to sufficiently restrictive rates. That means he wants to keep raising them. And he says we continue to see risks to inflation as weighted to the upside, which means he wants to still raise rates. But more and more, he's going to have to acknowledge the weak economic data. And so when he starts to acknowledge a weak housing sector, the next thing is, okay, it's a weak economy. The next thing is, okay, it's a weak employment market. Okay, we have to pause and wait and see. And we'll hike more if we see it pick back up, but we think the risks are more balanced now. And so, Joe, I'm going to pass it to you after this, and maybe you can strike our OIS curve and maybe just explain to people where each rate is, and where the terminal is, and how that has moved today. But right now we see Bitcoin at 19,400. So, right about at the levels where we were before the meeting. The stock market is basically flat on the day, nothing doing. And the VIX, the volatility index, is now down on the day. Lower fear on the day. Even though the Fed is talking about hike, 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 hike. Okay? So that's the message. That's my takeaway here. It is the markets are not afraid of the Fed anymore, that they're going to raise rates and just crush the economy and crush risk. Otherwise, risk would be crashing. And so you have to take what the price is telling you. The price is telling you that we have a divergence in yields and risk. Yields are in the front end 70 basis points higher than they were in June, but risk is above where it was in June. So that's not what you would expect. And so there's signal there. And that's really my takeaway. And then I'm going to pass it to Joe, and then maybe we'll get a couple questions in here. What's up, Joe?
What's up, Nick? Great conversation, all. Thank you guys so much for coming up. Croesus, I appreciate your thoughts. They're wicked valuable. Sovereign Stoic, I know you've been up here for a while. Feel free to unmute at any point if you want to chat. But for those who are in the space, make sure you subscribe to the Bitcoin Layer. The link is up in the nest. Just click that and you could get right to our newsletter. We do a free markets monitor weekly, keep you updated on Bitcoin through a macro lens. And macro is ultimately driving the show right now. And Nick, you're right. We're talking about a divergence between yields and risk. You see yields rocketing past, again, levels for the 2-year we haven't seen since 2007. And really, I think this is sort of the market's way of, again, like you mentioned, not fearing the Fed. I think the people who actually operate businesses and who exist within the real economy understand that a 4% risk-free rate is just untenable. And so they understand that a monetary policy path shift is going to have to happen sooner rather than later. Else, like Dr. Jeff said, you get this massive deflationary, this deflationary bust, and ultimately, that isn't going to solve structural inflation, right? If you're using interest rate policy, which is what the Fed has in its tool belt, but you've got these headwinds of deglobalization and coming off of the pandemic, extreme supply chain disruption, there isn't a whole lot you can do there from an interest rate monetary policy standpoint. And so what it's actually doing when the Fed is trying to destroy inflation, which is caused because of these huge supply crunches, is they're actually destroying the real economy, right? So they could stay aggressive here and then, sort of be bewildered as to why, core inflation isn't going down. When in reality, it's basically all it's doing is crushing the real economy. That's certainly an interesting thing, and seeing risk assets exhibit support sort of all across the board illustrates that, potentially the Fed's path is much shorter than it believes. Looking at OIS right now, it looks like the coming off of sort of the mania, and also as Powell speaks, it looks like it's coming back down towards looking like 50 for November. It's coming closer towards that 50 level. But rates do reprice quickly. Looking at the headlines here, Powell warns that U.S. labor market is likely to soften. I know that you just mentioned that. Fed seeks return to sufficiently restrictive rates. Neutral was 75 basis points ago, right? So we're already past neutral. We're already into restrictive. We are, I don't necessarily know the definition of sufficiently restrictive. I think that's, some clever wordsmithing on their part. But what would they categorize as sufficiently restrictive, right? If they don't see core inflation coming down next month, are they going to continue aggressively raising rates? Because, as we're talking about, a 4% risk-free rate simply isn't tenable for, the average American. We've had this 14-year regime of rates locked at or near zero. This sort of chronic misallocation of capital because money is free. And now we're essentially asking people to be paying, several percent more than that. We're asking them to finance their debt that they got at, 1%, 1.5%. We're asking people to, variable rate mortgages that they locked in at 2.5% to pay 6.5% or 7%. It's simply untenable. Whereas in 2007, it was a problem with bad lending standards. That was mostly relegated to housing. Now you're seeing bad lending standards across the board because you saw rates ratcheted down. Fed funds ratcheted down from 5% to 0%. following what happened in 2008, and it was held there, right, all the way through to 2018 when they began their hike cycle and then swiftly abandoned it. So essentially, you've had 14 years of almost interrupted, extremely cheap debt, created this tremendous amount of moral hazard, tremendous amount of bad debt. When we say bad debt, debt that wouldn't otherwise be taken out if there was an actual cost that was associated with servicing it. And now they're introducing a cost faster, more aggressively than we've seen since well before we had this amount of debt on our hands. So it's not a pretty picture. Powell just said, coming across the tape right now, we're at the very lowest level of what is restrictive. So I guess that answers my question right there. We are in restrictive territory. We're 75 basis points, 0.75% past what is considered restrictive, neutral, past what's considered neutral. So we're already in restrictive territory, and Powell only sees this as the very beginning of restrictive territory. So it seems like he still has his sights on 4.5 as the terminal rate. But frankly, again, at the Bitcoin layer, we don't see that as something that can occur, or at least occur for a prolonged period, without seeing the real economy move into shambles. But of course, we'll continue updating that, everybody, all our readers, all our viewers on that as it happens.
Absolutely. So again, thank you everyone for joining us. This has been a lot of fun, and we hope that you guys have enjoyed as well. Raise your hand if you want to come up and ask a question, and we can have a few people up here. But I want to point your attention to the markets. Bitcoin is up $200 approximately since the decision came out. Yields are back down flat on the day on the front end, and 10-year yields are down 4 basis points from our 357 level before the decision. Stocks are up on the day, over 1% now, and the VIX is down to the 25 handle. The market is not afraid. And I think it comes down to what Joe said. The 4% risk-free rate is untenable, and business owners and operators are going to be the one to deliver that message. In whatever way they deliver it, whether it's with words, with layoffs, or with prices, and meaning prices, slashing prices, right, to respond to a slow consumer. Because that's what happens when the consumer slows. You have to cut prices to sell your shit. So that's what we're expecting to happen, is the real economy will put the pressure on the Fed. They will be forced to understand that higher rate on the risk-free rate is untenable for the markets. Now, this all assumes that inflation will slow. So that's where we differ from the people that think we're heading to 4.5%, 5% Fed funds, that we're heading to 50% corrections in the stock market, that we'll head back to double-digit inflation if the Fed pauses, or even, I've heard somebody say the Fed will over-tighten. It'll send the global economy into global depression. Then the Fed will have to do QE so big that it sends inflation to double digits again. That's like crazy conjecture to me, and way off the mark. So we have to stay based in reality, and what is happening in this current cycle that we can see that inflation is coming down on a monthly basis now because of the energy prices. Core inflation is sticky as hell, and the Fed is saying we are going to hike until we get that core number down. So we will continue to be watching everything here at the Bitcoin layer. Go subscribe to our Substack. That's where we put out our premium markets coverage and analysis on the Fed. What I do is I do chart packs. I basically strike all the charts and give you guys the picture. What is happening over the last 2 years in this market? What can happen over the next 6 to 12 months in this market? How does it affect Bitcoin? What is the cycle? Where is the economy on a leading indicator basis? Not looking at GDP or unemployment, because those are lagging, but looking at leading indicators. So I want to bring up a couple people for questions. Dallas, why don't you start us off? Welcome and thank you. I still see the wheel spinning as he's trying to connect. Striking the markets, once again here, we have Bitcoin trading right around where it was going into the meeting, and the curve is, about 10 basis points flatter since the meeting. So that's the market action that we've seen. And Dallas, welcome on stage.
Yeah, thank you guys for having me, and thanks for doing this. Sort of have two questions. Want to just see kind of which you guys want to run with, but basically wanted to dig a little bit more for everybody listening. If you guys can add a little context as to exactly how you said, you think business owners and many, participants in the economy will communicate why, rates being at 4% and above are just untenable. So basically, could you guys, get or add a little bit of context and detail as to like how people will communicate that and what that may look like and what kind of signals you look for?
Well, number one signal for me right now is Jamie Dimon going out and writing his piece explicitly saying that. So that's one thing. When you start to see, Mr. JP Morgan himself go out and say that the economy can't sustain sustained high levels of interest rates, that's sort of number one. Number two, obviously, there's what do you call it? There's watching the labor market, right? Watching when the labor market rolls over, taking a look at continuous claims, right? How many people are on unemployment and staying on unemployment? Taking a look at what wage inflation is doing, sort of watching the labor market itself, but also watching what industry leaders are going out and saying. You'll also know that it's becoming too much for the economy, for the real economy, when you start to see politics get involved, right? So you start to see the Elizabeth Warrens of the world pivot from high inflation is killing the consumer to high interest rates are killing the consumer. We need stimulus. We need it now. When you start to see politics get involved, and we're moving into November, so that will play a key component. When you start to see the heads of banks get involved and start going up and talking on Capitol Hill as they are now, when you start to see people like Jamie Dimon, people like Jeff Bezos go out in the Washington Post and not in Washington Post, rather Wall Street Journal, and write that high interest rates are sort of a death knell for the economy, that's sort of when you can anticipate that the Fed, is sort of going too far in the eyes of the American consumer and their businesses. Will the Fed listen, or will the Fed continue keeping their earplugs in, their head in the sand? Time will only tell, right? But when the real economy begins to unwind, you start to see continuing claims stick up. You start to see mass unemployment. People begin getting very, very impassioned about these things through those channels that I mentioned, and also others. That's sort of when you can expect the Fed to change monetary policy path.
Yeah, and I'm watching housing as well as one of those. It's both quantitative and qualitative. It's quantitative because you have home price index data, you have construction data, you have new home sales, existing home sales, building permits. You have all this data that's going to come out, and it's already starting to slow. But the housing market itself is something that everyone talks about all the time. At your family dinners, your cocktail parties, front page of the newspaper, the local news, everywhere, everyone is talking about the housing market. And so that's what I'm going to watch. That's why I think that housing headline might have moved the market a little bit more dovish today. The housing market, remember, caused the 2007 unwind of the euro-dollar market. It was the U.S. housing market bubble, financed with all this debt that was in part 0% reserved on an offshore basis. And so the housing market is something that I'm watching really, really closely. And you guys will see us cover that at the Bitcoin layer. So we'll be watching the data. We'll be watching the anecdotal data as well, and some of the headlines. So Dallas, what's your second question?
Thanks. Yeah, and if wanted to ask you guys a bit about if you can add a bit more context too, because I could be wrong on the numbers, but I saw something to the effect of like 37% of like the debt that the Fed has is like set to sort of roll over, and it would be rolling over at like these new rates, I believe, if I'm not mistaken on that. So do you guys have any thoughts or context just on like, how much of that is, is the case, and what sort of impacts that has, obviously sort of increasing, the rates in which they need to pay, on bonds. I mean, is that possible to add a bit more
Yeah.
context on that?
So let's talk about the Fed's balance sheet for a second. And this is something we haven't talked about at all through over an hour on this, but it's a big factor here. And that is when the Fed does decide to pause, it can still parade around quantitative tightening, which is the reduction of the balance sheet. So I heard, Croesus say that it can't unprint the money. It is unprinting the money. It is destroying the money through quantitative tightening. It's letting the maturities expire, and it's not replenishing those securities. So that support, marginal support for the Treasury market and the Treasury's cash balance, is disappearing at the margin. So when the Fed pauses, it will be able to say, we are still tightening policy, even though we are pausing rates. And we do expect that quantitative tightening will have the desired effect of, at the margin, slowing down some of the inflationary impulses in the economy. So don't look too closely. My answer, Dallas, would be don't look too closely at what's maturing at the Fed level in terms of like the percentage of their portfolio. Look at more the quantitative or the pace of the reduction of the balance sheet and watch for that to continue. So the Fed, even though they have maturities, they still have caps, which means they will only reduce the balance sheet by so much. So even though, 30+% of it could be maturing, they are capped in the amount that they can let mature without replenishing. So
Yeah, so Nick, really quick to add some context there. Exactly like you mentioned, with the maturity profile, it isn't the most relevant thing to look at, but looking at the maturity profile of the Fed's U.S. Treasury holdings, it looks like through 2025, everything that expires through 2025 represents the majority of their Treasury holdings as of right now. So you're going to sort of start to see QT ramp up moving into next year. But the question also becomes, and I put it in the nest for everybody. I posted this the other day. It got some good traction because I think people resonate with it a whole lot. Every single time they've tried QT, right? And that is to say, every single time they've put out a balance sheet projection. We've only ever had sort of one sustained phase of QT. Every time they put out a balance sheet projection, they've gone ahead and run up the balance sheet beyond that. So way back in 2010, 2012, 2013, 2014, and then in 2019, when they began tapering in. And as of right now, we also have a balance sheet projection. Every single time they sort of had to reverse course because drawing this amount of liquidity from the system has proven unsustainable. Eventually, sort of there's this big liquidity crunch that's caused by the Fed allowing these treasuries to mature. And who knows how long this phase of quantitative tightening will last, given that historical precedent.
Yeah, thank you, Joe, for that. It's an important dynamic to understand. And so I'm going to close up shop here in a minute. I want to leave you guys with one last thought after I hit one more round of the markets. So I'm reading. I have Twitter up so I can see the headlines from the press conference, and I'm seeing Powell say much of the same. Hike, 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 slow inflation. It's our only goal. It's too hot. He's saying the same thing. Literally, he's quoted saying, "Inflation is running too hot. You don't need to know much more than that." So he's really just hitting us in the face with it. But then I'm going to point you to a tweet from Santiago Capital. This is the guy that his name is Brent. This is the guy that's famous for the dollar milkshake theory. It's also known as the dollar wrecking ball. And this is the idea that the dollar's strength is a burden to the rest of the world. And I actually recommend you guys go just on YouTube, go watch the dollar milkshake theory video. I think it's an important one. Brent is a good follow. He says, market keeps trying to call Powell's bluff. Fascinating to watch. And that is what we believe is happening here. Risk isn't selling off. Volatility isn't picking up. And now look at yields. Yields are 6 basis points lower on the day on the 10-year yield. The market doesn't buy this 4.5%, 5% Fed funds narrative. And it's starting to not buy the sustained inflation narrative either. So 5 to 10-year inflation expectations from the University of Michigan are still sub 3%. 5-year Fed inflation swap is also sub 3%. There is no runaway inflation risk in the market. And that is why the Fed doesn't really buy this whole 5% Fed funds nonsense. So that's our take at the Bitcoin layer. We're going to cover it like we see it. If risk breaks to new lows for the year, we're going to have to listen to that and really set forth a new narrative on what's happening. But you subscribe because you want our opinion, and hopefully our opinion is unique and hopefully also different than the rest. So thank you guys so much for joining. Really, really appreciate you coming in, and please go subscribe to the Substack and the YouTube so that you can keep on following what we're up to. Joe, why don't you close us out, dude?
For sure. Thanks everybody for coming. Foss, I see you requesting to come up on stage. Thanks so much for making time. You caught us on the tail end here, so bad timing, but we'll get you next time. I'll be on Spaces.
Let's get Greg to give us the last word. Everyone loves a good Foss rant. So
yes.
Foss,
and Foss, you missed it actually. We were talking about math a little bit earlier with the 2-year yield and how it sort of relates to rates and the path for Fed funds into the next couple of months. You missed it, but why don't you give us the final word here? Take us home.
Greg has a different take than us a little bit. I know he and I have that inside fixed income experience. But there's always two sides to the market. I know Foss has a little bit of a different take, but Greg, why don't you just take us out? And what are your thoughts here after the Fed?
So, hey guys, thanks for having me. Look, I'm in a small town in southern Ontario. So happy I could join you guys. Thanks for the invite. So I heard your excellent summary, Nick. Look, I'll just tell you two things. First of all, there's inflation expectations, and then there are credit risk concerns. Okay. And let's be honest, inflation expectations are subjective. Nobody knows. There's no hard and fast formula to calculate future inflation. What there are hard and fast formulas for is calculating credit risk in the here and now. I firmly believe that the USA better get their head out of their ass and figure out how to address the debt spiral, or 10-year rates are going to be trading off of credit risk, not off of inflation risk. Inflation risk is like you have zero control over that in terms of math. It's all subjective. It's probabilities, but no certainty. I know for certain that the credit metrics of the USA are so putrid right now that if it was a corporate bond, the USA would be rated triple C on its way to CA or double C, which is one level of default. The USA does not cover its interest expense by one turn right now. You people need to understand how dangerous that is. And fuck inflation. If you can't pay your interest expense, no one's going to lend you money. Okay? Full stop. You can pretend you're the best fucking credit in the world, but if no one lends you money, you're out of luck. And then the only people buying your bonds are your Federal Reserve. And then it's circular, and then it's the death loop, and welcome to Japan. So stop worrying about inflation so much, people, and start doing some credit work on the true credit metrics of the USA. It is fucking awful. And that being said, I have to give credit where credit's due. It's still the best horse at the glue factory because Canada's even worse. Okay? We are in a load of fucking shit right now, and nobody is doing the math on the credit side. Everyone's trying to project future inflation. Fuck that. Nobody knows. The Fed doesn't know. And when the Fed doesn't know, they're going to drive us into each guardrail because they don't fucking know. What they got to learn is to focus on the credit metrics. And if they were borrowing by a credit card right now, nobody in their right mind would lend the USA money at 3.5%. You guys are fucking stupid if you're lending the USA money at 3.5% when they have less than 1.5 times interest coverage. Go to the junk bond market. At least you'll get 14% for that type of risk. Over and out. Love you guys. God bless USA, because if the USA's fucked, Canada is off the rails long before that, okay? Go do the math. Thanks.
Foss, you're the man. We appreciate your rant. And I'll just close with a plug for my book, Layered Money, which is the other side of the story that Greg is telling, that even though the dynamics, we opened with this, even though the dynamics of the U.S. fiscal situation are terrible, that we admit, there is another dynamic, which is that treasuries represent the only true form of dollar in a post euro dollar world, and that is why there's a premium for it's the highest form of dollar you can own. So we call that first layer money in the book.
100%, 100%, Nick, and that's a good thing, except for everybody else in the world that doesn't live in the USA. And that's who I'm worried about, okay? So it's all good if the USA can survive and they have nobody to trade with in the world because nobody has any money, because the USA is a dollar wrecking ball that destroys all their trading partners. Y equals C plus I plus G plus net exports. Guess what? If you have no net exports, you got no ability to fund your C plus I plus G, okay? You guys know the math. Very simple. Over and out. I want you to buy Joe's or Nick's book. Why? Because always read research that's contrary to my opinion, because I know shit about fuck. I'll just tell you that you need to understand that the world will turn to a credit-based lending system from an inflation-based lending system. And yes, again, I'll say it, the USA is the best crack house on a crack street. So good on you, boys. Buy Bitcoin. Thank you.
Buy
Love
Bitcoin.
you, Foss. Thank you very much.
Buy Bitcoin indeed. Thanks, guys, for joining. We appreciate it. We look forward to doing this again on November 2nd. Find us at thebitcoinlayer.com, thebitcoinlayer.com for all of our links and to find us everywhere. Thanks, guys. Take care.